The stock market can decline for a variety of reasons, often driven by economic, political, and social factors. Here are some common reasons why the market might be down nowadays. Economic uncertainty, inflation. Rising inflation can erode purchasing power and lead to higher interest rates, which can negatively impact stock prices. Interest rates. Central banks, such as the Federal Reserve, may raise interest rates to combat inflation, leading to higher borrowing costs and reduced consumer spending. Recession fears. Concerns about an economic downturn or recession can lead investors to sell off stocks and move to safer assets. Geopolitical tensions, conflict, and war. Ongoing conflicts or the threat of new wars can create uncertainty and volatility in the markets. Trade disputes, tariffs, and trade wars between major economies can disrupt global supply chains and affect corporate earnings. Corporate performance, earnings reports. Poor earnings reports or guidance from major companies can lead to declines in stock prices. Profit warnings. Announcements from companies warning about lower than expected profits can spook investors. Regulatory changes. New regulations. Changes in regulations, such as increased scrutiny of big tech companies or new environmental regulations, can impact certain industries. Tax policy. Changes in corporate tax rates or other tax policies can affect corporate profitability. Global events. Pandemic resurgence. New waves of COVID-19 or other pandemics can lead to lockdowns, reduced consumer spending, and supply chain disruptions. Natural disasters. Events like hurricanes, earthquakes, and other natural disasters can impact economic activity. Market sentiment. Investor sentiment. Negative sentiment and fear among investors can lead to sell-offs. Market corrections. After prolonged periods of growth, markets can experience corrections as investors take profits and reassess valuations. Supply chain issues, logistics problems. Ongoing supply chain issues, such as shipping delays and shortages of key components, can impact companies' ability to produce goods and meet demand. Energy prices. Fluctuations in energy prices, particularly increases, can increase costs for businesses and consumers alike. Monetary policy. Quantitative tightening. Central banks reducing their balance sheets and withdrawing liquidity from the market can lead to lower stock prices. Interest rate hikes. Expectations or actual increases in interest rates can reduce the attractiveness of stocks compared to bonds. Current example factors. As of 2023 to 2024, inflation and interest rates. Persistently high inflation has led central banks to raise interest rates, which has created concerns about reduced consumer spending and higher borrowing costs. Geopolitical issues. Ongoing conflicts and geopolitical tensions, particularly in regions like Eastern Europe and the Middle East, have contributed to market uncertainty. Tech sector. The technology sector, which had seen significant growth, has faced regulatory challenges and valuation concerns, leading to declines. Understanding these factors can help investors make more informed decisions and better navigate the complexities of the stock market. Always consider consulting with a financial advisor to tailor strategies to your specific situation and goals.